Welcome.
Thank you very much. Greetings. This is Makerere University Business School, here to deliver our evaluation on Kenya Commercial Bank. And the team is Maria, Benon, Judith, and Faith, and I'm Billy. Our presentation is going to run through the highlights, business overview, why invest, valuation, and financial analysis, risk analysis, and the conclusion. This is Kenya Commercial Bank Group, opening a world of possibilities. From our analysis, we issue a buy recommendation for Kenya Commercial Bank Group. This is at a one-year target price of 61.3 Kenyan shillings with an upside of 9.5%, total expected return of 20%, backed by a qualitative analysis. We see that the major drivers of the group's business are the sustainability business strategy, innovation and technology. These have enabled them to cut their costs, grow their customer base, thus leading to a stronger balance sheet. Tracking the stock market performance for the last decade, we see that after the financial crisis, the share price has been steadily rising, which is an indicator of a good stock. And this is from last year. I now hand over to Maria to take you through the business overview.
Thank you, Billy. Looking at the KCB Group business, one of its drivers is wide coverage and business consolidation, evidenced by the subsidiaries it has had since 1997. It has driven efficiency while growing market share over the years, and its major shareholder is the Government of Kenya, holding 17.5%. The group's major core business is investment and corporate banking, and it has a future focus on retail banking in order to ensure sustainability. In an attempt to diversify business, the group is venturing into banker assurance, and this has allowed it to tap into the insurance business. With partnerships like Biashara Smart, Mtami Agent, the group is providing its key products and services. For example, M-Banki, a platform that enables its customers to transact on their mobile sets. The group has a regional market share of 14.5%, and Kenya constitutes most of the customers, mainly from the corporate group. The group has demonstrated a good track of performance, and by the end of last year, it has shown a return on average equity of 26%. And in comparison with its corporate peers, the group is performing well as with its retail peers, despite the competition. With strong financials and a good global credit rating, the group is harnessing the opportunities in innovation and technology in order to overcome the threats of competition. Benon will continue.
Thank you, Maria. I'll now take you through the regional banking industry and macroeconomic analysis. The industry consists of majorly commercial, investment, microfinance, and development banks. The customers include SMEs, retail, and corporate groups, and the products demanded are savings, current accounts, loans, and mortgages. By market, we see that the regional bank asset growth rate grows more than twice the regional GDP growth rate, with Kenya being the most dominant market, while South Sudan and Burundi are the smallest markets. The industry has opportunities in regional integration, as well as unbanked customers, with regulatory pressures being the major challenge. We also tracked down the regional interest rate movements in 2014 and arrived at a favorable average rate of around 10%. We also used the Porter's 5 forces model to analyze the market competition, and from our analysis, the major threat is intensity of rivalry. Moving on to the regional macroeconomic analysis, the region grew at a rate of 6.2% in the last decade, majorly driven by FDIs, SMEs, and banks. This growth is expected to increase due to further East African integration and the budding energy sector. However, inadequate infrastructure and the unpredictable political climate will be the major challenges. Respectively, the 6 economies will also grow more due to the increasing investment freedoms within. Lastly, from the illustration on the left, we see the annual GDP growth rate by country in the last decade, and on the right, we see the regional inflation rate movements, whereby a single-digit average of less than 6% was contained. We conclude by saying that the region is very viable for investment. Judith.
Thank you, Benon. After understanding the regional economy and banking industry, this is why you should invest in KCB Group shares. First,
The group boasts of a large asset base, a rising and high profit before tax, a large asset base, large number of customers, and big market share. The group also focuses on lowering cost of funds through improving technology, and the result is that the earnings and dividends per share continuously rise. Lastly, all KCB Group activities are backed by the sustainability strategy, and this will ensure that all their business remains profitable. From our regional financial services penetration, we saw that 42.8% of the regional population constitute unbanked customers. This will give KCB Group more market to venture into. Also, from our financial analysis, the KCB Group's total assets and profit before tax will more than double by the year 2020. The same goes for earnings and dividends per share. This emphasizes that investing your resources in KCB Group shares will bring you nothing but handsome returns. Faith?
Thank you, Judith. After looking at why you should invest in KCB Group, I will go through the financial analysis to affirm why you should go ahead and invest in KCB Group shares. From our analysis, customer deposits will grow at an average rate of 20% due to the rising consumers within the region who are the major customers of the group. This will provide the group with a cheap source of funds. Net loans are expected to grow at an average of 13%, whereas cost-to-income ratio is expected to drop to an average of 46%, which is below the group's target of 49%. Total assets, debt to equity, net interest margin, and profit before tax, earnings per share, and dividends per share still are forecasted to remain favorable within the group. Comparing the group with its peers, the group is competing favorably and the financials are within the market range. Moving on to our valuation summary, we use the residual income valuation method because it considers all the cost of capital in generating income. It also provides an opportunity cost of why you should invest in the company's shares. From our valuation, we arrived at a one-year target price of Kenyan shilling 61.3, a total expected return of 20%, and a premium of 1.6%. We also used the CAPAM model to derive the cost of equity with a risk-free rate of 12%, equity risk premium of 5%, giving us the cost of equity of 18%. Customer deposits, we also carried out a sensitivity analysis to show what would happen to the group's target price as well as the total expected return in case of a drop in its performance of its core business. That is the customer deposits and the customer loans. And we see that a drop in the customer deposits and loans by 5% will reduce the target price to 34.84 Kenyan shillings. The premium will reduce to negative 43.2%, and the expected total return will reduce to negative 32.9%. However, this is most likely to unhappy to increase on its customer base. I now call upon my colleague Billy.
Thank you very much, Faith. In every investment decision, there are risks. And we see that for Kenya Commercial Bank Group, competition is a concern. This is because any other player can disrupt the market at any one point. Management risk is low, while we see that political risk, despite its impact, because the group operates over 6 countries, they are in position to absorb shocks from either one. A more detailed breakdown of the risk is as follows, and we see that they've been able to stay ahead of these risks because of the strong investment in checks and checks and monitoring, which has enabled them to capture risks like foreign exchange and interest rate movements. And then we move, in conclusion, we see that Kenya Commercial Bank is a very viable investment option. It has been recognized for having the second most liquid counter on the stock exchange, Nairobi, and for being committed to excellence. And this is this reiterates that the secondary market is good for investors, and it is a bank that's committed to what it says. We stand by our buy recommendation based on expected return of 20%, qualitative analysis, and an upside of 9%, to say that at a 61.3 Kenyan shilling price, should be invested into. Thank you for listening.